Welcome the management of IndiaBulls Housing Finance on the call to discuss Q4FY18 results. From the management team, we have Mr. Gagan Banga, Vice Chairman, MD and CEO, Mr. Ashwini Huda, Deputy Managing Director, Mr. Sachin Chaudhary, Chief Operating Officer, Mr. Mukesh Garg, Chief Financial Officer, Mr. Ashwin Malik, Head Treasury, Mr. Ramnath Shenoy, Head Investor Relation and Analytics, Mr. Harshil Suvankar, Head Markets. I now invite Mr. Banga to share the key details of the result. Over to you, sir.
I wish all of you a very good day and I welcome you to the Q4 and full year fiscal 18 results call. The year gone by has been very momentous for us. Our upgrade to the highest long-term AAA rating by CRISIL and ICRA firmly lays the foundation for long-term sustainable and profitable growth. Other important milestones during the course of the year which we achieved were: in the first half, our loan assets crossed rupees 1 trillion, propelled by strong growth in mid-income affordable housing, which is our core business segment. Since Q3 fiscal 18, we are now clocking a profit after tax of rupees 10 billion a quarter. For the first time, our loan sell-downs in fiscal 18 crossed 100 billion, from 42 billion in fiscal 17. We sold down an equivalent of a third of incremental loan assets that we added this year. At first hand, we see strong traction for loan sell-downs, and this very efficient source of funding makes our funding outlook all that much more stronger and capital more efficient. We also issued India's first social affordable housing bonds of rupees 10 billion. The proceeds of which will be used towards financing the affordable housing sector. These bonds conform to the social bond principles of the International Capital Market Association, ICMA, with assurance to principles being checked by KPMG. We issued rupees 27.5 billion of subordinate Tier 2 bonds, boosting our capital adequacy to nearly 21% levels against a regulatory requirement of only 12%. This will help us maximize ROEs. Our e-home loan product has now evolved into a comprehensive IndiaBulls integrated home loans technology platform. This platform will be driven by a strong data analytics engine and also brings on developer and external channel partners like DSAs and developers into the interconnected network. Technology Trust will drive IBHFL's next phase of growth, and we are already seeing tangible operational as well as financial benefits from our technology initiatives. Over fiscal 18, the real estate sector has strongly picked up. Sub-rupees 2.5 million home loan disbursal growth was at 33% in fiscal 17. This was before the extension of PMAY credit link subsidy scheme to our core customer segment of mid-income home loans. The numbers for FY18 are expected to be still stronger. An indication of a very strong near-term growth is in comparison with China's individual mortgage market, which is at $3.5 trillion and is 14x that of India's $245 billion mortgage market, while China's GDP is only 5x that of India. With a GDP growth that is in line or higher than that of China's, it is on very sound grounds that I expect very strong 30% plus near-term growth in this segment. And both the residential and the commercial real estate markets are already showing signs of this. In slide 16 of our earning update, we have shown how there is strong pickup in affordable housing segment across the country. In December 2017, the rating agency ICRA states that it expects credit growth in this segment over the medium to long term to be at over 30%, resulting in an increase in mortgage penetration to 12 to 14% from the present 9.7% of GDP by March 2022 itself. According to another industry report, residential sales in sub-rupees 30 lakh category saw a jump of 33% YOY in the second half of calendar 17. Also, the share of sub-30 lakh category in residential sales has increased to 27% in the second half of calendar 17 from 24%. Residential sales in Mumbai metropolitan region and the National Capital Region of Delhi market grew by 32% and 28% YOY respectively in second half. Traction was also seen in launches in mid-income affordable housing category with over 44% of launches in calendar 17 happening in ticket sizes of less than 40 lakhs. The premium market too has started to show signs of recovery. Bangalore witnessed a 45% jump in demand for premium residential living space. It also exceeded the target that the government had set for registration duties. Uptick in high-income group sales was led by Mumbai and NCR regions, with each registering 20% YOY growth in the second half of calendar 17. Commercial office space absorption, which is a lead indicator of housing demand, recorded leasing of over 10 million square feet in quarter 1 calendar 18, which is a growth of 25% YOY. This was led by tech corporates, BFSI sector and e-commerce companies, which contributed to 64% of the absorption. For the past 3 years, commercial office space absorption in the country has been over 40 million square feet every year. As per a Knight Frank report of February 2018, office space vacancy was at a 10-year low in calendar 17. Key Indian IT hubs such as Bangalore, Pune and Hyderabad have vacancy at mid-single-digit levels. According to the rating agency CRISIL, office rentals saw strongest ever appreciation in most major markets with a growth of 5% YOY, and rentals also are expected to grow by 5 to 8% YOY in high demand micro markets across all the top 8 cities. As per a report by CBRE, office space addition grew 3 times to 9.7 million square feet during quarter 1 calendar 18. In our core consumer-focused mid-income home loan segment, the competitive landscape could not have been more conducive for us. Slide 14 of the update shows how housing finance companies have been steadily gaining home loan market share from banks and now account for 41% of the stock of the country's home loans, up from 33% in fiscal 10. On an incremental basis, housing finance companies now extend more than 50% of the home loans in India in fiscal 18. Given the asset quality issues and other distractions that both private and public sector banks are grappling with, in the bank scheme of things and order of priorities, home loans continues to not be the key focus area that this competitive product requires. A very interesting report released by the Reserve Bank of India in January 2018 on affordable housing shows that public sector bank NPAs are 2.5 times that of housing finance companies. Consequently, the field is very much open for focused lenders like IndiaBulls Housing. Besides the near and mid-term issues, banks have larger structural issues requiring long, drawn-out solutions. 13 banks, over half of all the public sector banks, are in prompt corrective action of RBI and are thus rendered practically useless. Even the much-touted bank recapitalization, which had earlier in the fiscal caused a lot of concern, has barely made any positive impact on banks' performance or competitiveness in the home loan space. The transition phase of RERA and GST are now well behind us. The benefits of these two major reform measures are now becoming evident. RERA has led to beneficial consolidation in the real estate industry, with single plot, one project developers that used to form the vast majority of non-organized real estate developer segment, increasingly entering into joint development agreements with larger organized players. The whole industry is now getting capital efficient. The larger developers do not have to lever up their balance sheets as the small partner brings in the land. RERA rules require proper formal working capital finance to be put in. Thus, working capital finance and the kind of construction finance that we can give out, that demand has gone through the roof. GST has had a similar impact with postponement towards the end of the project, or postponement of sales happening. GST has also had an impact on the self-employed segment, which is extremely positive. Self-employed underwriting is a core strength of IndiaBulls over the years, and over the last 15 years that we have been doing this business, our portfolio has gone through at least 3 to 4 credit and interest rate cycles. It has also seen demonetization, RERA and GST. 30% of our home loans and all of our LAP loans are to the self-employed small business owners. GST has drastically cut the cash component in the business. Formal books have strengthened, and many that were earlier operating in the unorganized segment are now in the formal mainstream. All of these are, over the next few years, going to become a ready market for a formal financier like IndiaBulls Housing. Before I go into the key financials, I am very pleased to announce that the board has approved an interim dividend of Rs 10 per share. Dividends have risen from Rs 9 per quarter to Rs 10 to keep pace with our guidance of paying 50% of profits as dividends. We have grown strongly across all key parameters. Our balance sheet at the end of fiscal 18 stood at 1.32 trillion rupees, up 27.2%. Our total loan assets are at 1.23 trillion, up 34.3%. At the end of fiscal 17, it was at 913 billion. Profit after tax for the year is at 38.5 billion rupees, up 32.4% from 29.1 billion rupees for fiscal 17. And PAT for the quarter is at rupees 10.3 billion, which is up 22.6% from 8.4 billion in quarter 4 of fiscal 17. Our top line has registered a healthy growth with revenue for fiscal 18 at rupees 146.4 billion, which is a growth of 25.1%. Of this, 121.1 billion is from interest on the loan book, 13.37 billion from cash and liquid investments, 6.5 billion from fees, and 5.42 billion from sale of equity stake in Oak North Bank in quarter 3. Our top line for quarter 4 fiscal 18 were at 39.7 billion, growing 25.1% on quarter 4 fiscal 17. The NII for fiscal 18 stood at 57.85 billion, a growth of 21.3% over fiscal 17 NII of 47.68%. I request you to refer to slide number 23, which is a new slide that we've introduced, which talks about the various sources of revenue for the company. We are perhaps a very unique mortgage-focused franchise in India, which has not only a large portion of the income coming from interest income, but we have been able to very successfully diversify the sources of revenue to go beyond just pure interest income. 1.6% of disbursals is accounted for in the context of just fee income without even taking into account the other penal and loan recoveries that we do. Loan sell-downs earn us a spread of 3% and are further complemented by an active syndication desk that we run. And even the liquidity that we carry continues to get us a return of over 7%, thus beefing up either our net interest income line or our profit after tax line. And as we look forward towards more and more technology integration, we expect the fee income to only go up from here towards 2%. As we focus more on the home loan segment, loan sell-downs will continue to be at least a third of our book. And we are quite confident that we will not be getting a massive negative carry on the liquidity buffer that we have. As a result, the net interest income for the quarter stands at 16.61 billion, a growth of 22.2%. We've been focusing hard on reducing our operating expenses. Our cost-income ratio, which in fiscal 11 used to be as high as 21% in fiscal 18, has declined to 12.5%. OPEX stands at 8.53 billion, up from fiscal 19 OPEX of 7.3 billion. OPEX for quarter 4 was at 2.06 billion against 1.98 billion in quarter 4 last year. With the increasing penetration of e-home loans and increasing digitization, we are confident that we will continue to tread the path that we have since fiscal 11. we have already brought down the cost-income ratio from 21 to 12.5%, and this will continue to decline towards single digits over the next couple of years. Our net credit costs for fiscal 18 stood at rupees 10.36 billion, excluding the one-off provision of rupees 1.8 billion that we made from Oak North stake sale. The credit costs were 8.6 billion. Net credit costs for quarter 4 FY18 are at 4.12 billion versus 3.11 billion last year. For the past 27 quarters, our NPAs have been within our guided range of 70 to 90 basis points for gross NPAs and 30 to 50 basis points for net NPAs. Gross NPAs and net NPAs were down to 77 basis points and 34 basis points respectively from 85 bips and 36 bips a year ago. In computing net NPA, only provisions against substandard assets is deducted from the gross NPA. Standard asset provisions and countercyclical provisions are not deducted while computing net NPA. Our total provisions stood at 17.58 billion, translating to a total provision to gross NPA cover of 185%. The total provision of 17.58 billion also contains a 4 billion of countercyclical floating provisions. We have 8.66 billion of provisions in excess of regulatory provisions. Now moving to the balance sheet numbers, our net worth at the end of fiscal 18 stood at 134.24 billion rupees, up from 121.22 billion last year. Total capital adequacy adjusted for investments in mutual funds stood at 20.82% with Tier 1 at 15.07%. This quarter we have disbursed a total of 195.54 billion, a growth of 35.5% over last year, in which we had disbursed 144 billion. Our home loan book now stands at 726 billion, forming around 60% of the total loan assets. Our home loan book has grown 44% YOY. We are on track to get to our stated target of home loans forming around 2/3 of our loan assets by fiscal 20. Driven by increasing share of home loans, the ratio of risk-weighted assets to loan book has dropped to 78% at the end of fiscal 18 from 83% last year. Risk-weighted assets to loan book is a strong indicator of risk being underwritten, and a declining ratio is also indicative of frugal capital utilization. On the borrowing side, bank borrowings form 34% of our funding mix, down from 37% last year, same quarter. Capital market sources along with ECB and sell downs have contributed to over 75% of the incremental funding since March 2017. Our cash and liquid investments stood at 165.35 billion at the end of fiscal 18. The quarter which gone by was most talked about because of the sharp rise in GSEC yields post the budget. Corporate and sovereign yields were up by 30 to 40 bips from the pre-budget levels and 100 to 140 bips from mid-2017 levels. However, specific to IBHFL due to the rating upgrades, lower bond pricing for fresh issuances combined with refinance of stock of earlier issued bonds and ECBs enabled us to offset most of this macro rise in rates. This quarter, we've also issued rupees 16.5 billion of Tier 2 subordinated bonds. Further being the final quarter, demand for portfolio securitization was also reasonable, as there was large requirements of pools, especially on the priority sector side. All of these combined have helped us to effectively control our cost of funds and also manage capital efficiency. We've also set up a $1.5 billion MTN program last year, through which we will tap the offshore market from time to time to optimally diversify our funding sources and further increase funding efficiencies. We did a very small round of $50 million only, issuing India's first social affordable housing masala bonds in January 2018, conforming to the social bond principles 2017 issued by ICMA. We will look to utilize more of our remainder 700 million RBI approval limit in the first half of fiscal 19. As mentioned earlier, over the last 2 quarters, we've also issued a total of 15.4 billion of social affordable housing bonds, and these are being checked by KPMG for adherence to the ICMA principles. Another big positive for the year was that we crossed the landmark of selling over 100 billion of loan assets to banks. This was the highest ever sell down recorded for a financial year by IndiaBulls Housing. We are focused on capital conservation, and selling down loan assets is extremely capital efficient, freeing up capital while retaining spreads, making this transaction highly ROE accretive. We've gotten to a 30% ROE thanks to an active sell-down strategy. As we move towards fiscal 2020, portfolio sell-down will contribute to an increasingly larger proportion of our funding mix, and from the current 10-11%, we hope to see that rising to almost 20% levels. Cost of funds on book basis is at 7.75% and continues to drop as we refinance our stock of loans with finely priced loans. On an incremental basis, the cost of funds was at 7.65%. These are monthly rates. Our spread at the end of fiscal 18 on book stood at 311 basis points, while on incremental book it stood at 277 basis points. Most lenders, including IndiaBulls Housing, have since then increased rates. We have increased rates effective from 1st April 2018. Our PLR has increased by 20 basis points for home loans, and this will entirely add to the Q4 spread of 311 basis points. This demonstrates the resilience of our spread, which for over now 5 years has sustained within our guided range of 300 to 325 basis points, while the home loan proportion on our book has increased from about 35% to 60% in the same period. We have effectively proven yet again that we continue to be a transmission vehicle with the ability to almost immediately pass on any rise in our input cost of funds. There was much concern last quarter on how our loan spreads will hold up with the upward movement of interest rates. I had made the point that even with appreciable hike in interest rates due to tailwinds from our upgrade, rating for our incremental funding cost will be lower than the funding cost on the stock of borrowings. True to this, our cost of funds for Q4 on stock of borrowings was down by 17 basis points to 7.75%. The yield on our stock of loans was at 10.86%, resulting in a spread of 311 basis points. Our underwriting strength and the ability to get a slight pop on our book is evident in the resilience of our LAP book, all of which are loans to small business owners. In the 13 plus years that we've been doing LAP lending, the portfolio has seen multiple cycles. Even through the most recent challenges like demonetization and GST transitions, our self-employed book saw no worsening in credit quality. If you refer to page 42 and 44, you can go through the latest reports of CRISIL and ICRA on our LAP book. And page 47 onwards, we've also published an update on the static delinquency analysis of both our home loans and our LAP books. This is extremely relevant because this has come in the phase after GST has been rolled out and is now starting to stabilize. The first phase of IndiaBulls Housing Finance growth was equity-fueled. As our ratings improved through this period, we firmly established ourselves as a prime, low-risk, mass-market home loan lender. Today, we have the highest long-term rating, AAA, from all 4 leading Indian rating agencies. Our strong liability franchise spread across diversified funding sources and an optimal mix of loan products gives us the best-in-class spreads that are sustained within our guided range of 300 to 325 basis points. In slide 7 of the earnings update, we bring out our strong business fundamentals. If you can all please refer to slide 7. Akin to banks, we have access to deep pools of debt and equity capital. Our processes and risk management practices are at par or better than that of most banks. But as an HFC, we cater to an asset class that is immensely scalable and profitable. I've already run you through the numbers of where China is versus India. And our 9.7% mortgage to GDP penetration reflects that we have a long headway to continue to grow. we are focused on catering to the mid-income customer segment. Our relationship with customer is long-term, during the course of which there are multiple cross-sell opportunities which allow us to complement our net interest income. Our product suite, fee generation opportunities and operating efficiencies translate into our ability to sustain a 3% plus spread in the business and an ROE of 25% plus. The next phase of evolution for us, and indeed for the industry, is technology. We were first movers here with e-home loans platform that we launched nearly 2 years ago. Already around 25% of our incremental home loans are sourced through the e-home loan platform. We made considerable investments in IT and are now well underway to launch a comprehensive IndiaBulls integrated home loan technology platform in fiscal 19. Various modules of this platform will go live from Q2 fiscal 19 onwards. If you can please refer to slide 34 of the earnings update, slide 34. Components of the IndiaBulls integrated home loan technology platform and the tangible operational benefits and the impact on financial performance are enumerated on slide 34. E-home loans will integrate onto the platform, and our analytics engine, drawing from credit bureau history, banking information and tax filings, will decision home loans on a real-time basis. The platform will also tie up access to GST filing database, providing credit teams with authentic revenue information on small businesses for LAP underwriting. Today's deliberate and long-drawn credit appraisal process will be considerably quicker without any compromise in credit rigor. This will help IBHFL maintain the proportion of self-employed loans, even as we aim to grow upwards of 25% in the home loan segment in the near to mid-term. This will in future help us sustain spreads at 3% levels. Analytics and social media integration will give us means to stay engaged with our customers, helping us better anticipate their needs, opening up cross-sell and resultant fee generation opportunities. Thus, our fee income, which is currently 1.6% of disbursement, will tend towards 2%. Another big change that this will bring about is the platform's ability to also link with developers and channel partners such as DSAs. We will have the ability to process home loans on construction sites itself as the buyer concludes his purchase, and we will be able to immediately disburse to developers, crunching developer working capital cycles both at the initial disbursement stage and through the course of the home loan disbursement, which typically gets tranched and gets disbursed over 2 years. Developers will raise demand for subsequent tranches on the platform, and the tranche can be disbursed almost on real-time basis, which we hope will result in us becoming preferred financiers, significantly increasing our home loans per project. A few clear financial outcomes that we target through this technology initiative are long-term sustained loan book growth of around 25%, enhanced fee generation to 2% levels from 1.6%, operating efficiencies resulting in cost-to-income ratio going to single digits, reducing our credit costs to under 50 basis points. The IndiaBulls integrated home loan technology platform will help us comprehensively address mid-income affordable housing loan market. As illustrated in slide 35, we will have multiple touch points to reach out to our target customers spanning digital channel, our existing 3,000 strong feet on street, which is continuing to grow every day, nearly 300 pan-India brick-and-mortar branches, which are also continuing to grow every day. Our technology and analytics-driven processing capacity is elastic, with a digital channel that can underwrite loans on a real-time basis at one end to the traditional pen and paper application form route. As we grow further from here on, we will firmly remain focused on our target segments in home loans. These segments are illustrated in slide 28. A couple of quarters ago, I had said that we will put forth our 5-year plan till fiscal 23 in the FY18 earnings call. We have every confidence that we will meet these numbers. Our balance sheet and loan book will compound at 25% going past first 2 trillion rupees by fiscal 20 and then double from there to 4 trillion rupees by fiscal 23. Our earnings should compound at over 22%, growing to 55 billion by fiscal 20 and then 100 billion by fiscal 23. Our target for cost to income is sub 10% in fiscal 20 and 8% by fiscal 23. Annualized credit costs should slip to 50 basis points by fiscal 23. We continue to see good traction on our smart city home loans. Our geographical mix that now stands at 70% from top 20 cities and 30% from remainder should even out to only 50% from top 20 cities. Through all of this, we expect our spreads to sustain at around 300 basis points level. I cannot be more optimistic for IndiaBulls Housing Finance prospects. Fiscal 17 has been, if not our best, amongst our best years ever. If you refer to slide 63, we've tried to summarize the various strengths that IndiaBulls Housing sits with at the end of fiscal 17. These are our strengths and would continue to remain our areas of focus. And I am quite confident that with all this performance and these strengths with us and such a confident and able team, we should continue with this journey of creating scalable and sustainable value for all stakeholders. Thank you so much. We can now open up for questions.
Sure, thank you very much. We will now begin with the question and answer session. Participants who wish to ask questions may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Kunal Shah from Edelweiss Securities. Please go ahead.
Yeah, congratulations. Good set of numbers. Firstly, in terms of contingency provisioning, so had we done something in this quarter to the tune of, say, 200 odd crores, 220 odd crores?
Yeah, total credit costs for the quarter are at about 400 and... the total credit costs are at about 412 crores.
Yeah.
Of which floating provisions are at about 145 crores.
145 crores. And standard and NPL, so floating and contingency, how would be the broader breakup within this?
So floating would be 145.
Yeah.
Substandard is 180.
Yeah.
And standard asset provision is 86 crores.
86 crores. So overall, in terms of the floating provisions, maybe last time we had this advantage of the stake sale and we had made some counter-cyclical provisioning as well. So how would be the policy out there, particularly with respect to this going forward as well, in terms of the floating?
So now we would want, we have an excess provision pool of roughly 800 crores. We would want that to continue to grow, and the excess provision should be, which are at about 80 bips of loan book, should increase to about 100 bips of loan book.
100 bips. Oh, okay. And secondly, in terms of disbursements, so how has been the number in this quarter? And
yeah, so we've disbursed, one second. We've disbursed around 19,500 crores.
19,000?
500 crores. Yeah. Overall disbursements for the year are 48,000 crores.
Okay. And this now 19 between the home loan and LAP?
Home loans are at about 9,900 crores, LAP at 2,600, and commercial loans at 7,000 crores.
Okay. And lastly, in terms of any inorganic opportunities which we would be evaluating, maybe now we have reached a particular phase with very strong fundamentals. And so how would be our view in terms of the inorganic opportunity, be it in terms of the affordable housing segment or any other area?
So the top 5 housing finance companies control about 93% or so of the overall stock of housing finance loans by HFCs. So in that context, I'm not sure what is available in the top 5. If something is, it'll be interesting to see. From a growth opportunity point of view, there is the macro, which I have highlighted. There is also a certain glide path that we've been following, which has been set by the largest housing finance company. So we are around where they were in 2011. And since then, they've grown about 3 times. So I believe that the opportunity to get to 4 trillion rupees has already been demonstrated, and we continue to follow that. If there is anything which is material, which goes beyond 1 or 2 quarters of growth, we will take a look. But generally speaking, I am not aware of which housing finance company which is of a size which is beyond 2 quarters of growth for us is available or going to be available. So come the opportunity, we will evaluate. But as we speak, I am not aware of what's worth the effort of going through a process of integration of team systems, etc.
Okay. Okay, so maybe 2 quarters of a growth would be say around about 15% in the overall size than our balance sheet.
Yeah, so if there is something which is beyond that, which is available, we will take a look. Smaller than that, I think we'll not even take a look.
Oh, okay. Yeah, thanks a lot.
Thank you, Kunal.
Thank you. The next question is from the line of Sunil Tirumalai from Credit Suisse. Please go ahead.
Hi, thank you very much. Congrats, Gagan, on good numbers. I have a couple of questions. So, was there any one-off in the OPEX that kind of seemed a bit low for the quarter? And what's the or is this the true number? Because last quarter I believe there were some one-offs. So, is this the base number?
No, so we had front-loaded our employee hiring, and we had completed our CSR charge in the first 3 quarters itself. I think bulk of it was taken in quarter 3. So we did not have any CSR this year. So in that context, we have been able to have only a very marginal growth in our operating expenses over previous quarter 4. Generally speaking, we will have to time hiring from time to time, and sometimes we will front load and sometimes we will not be able to front load it. In fiscal 19 also, our intention is to front load hiring both at the mid-management level as well as the junior management level, including the feet on street. So, and that's how, in all probability, we will continue to plan our operating expenses. So the first 2 to 3 quarters, you will see a faster pace of growth, and then the 4th quarter will see a slower pace of growth. The first 3 quarters also see increments coming in and bonuses being paid out, so that also has an impact.
Got it. The second question is on the the new slide on the fee income, investment income, etc.
Yeah.
So 1.6% of disbursement. I would be surprised if you make that on the home loan segment.
No. So we don't make it on home loans. It's
so which means that in the non-loan segment, what is the percentage typically?
In the home loan segment, it's a small processing fees, but we are able to attach almost 1.3, 1.4% of, and at times even 2% of the loan amount as commission. And given our payouts, we are able to get a pretty handsome return on home loans also. The commissions that we've been able to negotiate with insurance companies. And then loans against property, there is a hefty processing fees. Add to that the insurance commission, and again on commercial loans there is a reasonable processing fees. There is negligible insurance income as a percentage of loan there. So as a combination, it's a function of both processing fees and insurance income. And then what we've also started doing is, since the proportion of home loans has been increasing, and therefore the tenor of engagement with the retail customer, which in LAP used to be around 4 years, has now increased to 7 years. Our ability to sell multiple insurance products through the course of our engagement with the customer has gone up materially, especially given the fact that if you refer to the slides on which detail out the product, slide number 29, you will see the average age of the customer is around 38 years. So generally around 34, 35 years is when the engagement with us starts, and at that time, families are expanding the most, maximum number of assets are being acquired. So all that requires insurance. So all this adds up to the fee income that I'm talking about.
Okay, so seems like in insurance for a home loan, it normally works out to 1% of disbursement, is it?
Little over 1%, almost, I would say closer to 1.5%.
So this is like the credit protect kind of plans?
There are 3 or 4 different products that we try and sell. So the most remunerative for us is a group life insurance policy that we sell. We target to get about a 85% plus attachment rate. So we either sell a group life product or we sell a home protect product. The thesis behind or the risk principle behind insurance still continues to be that it's primarily a risk management exercise. Willy-nilly, it also lands up making us reasonable money.
Got it, understand. And
so like last year, almost across the entire portfolio, there were 150 claims made of either people who died or people who met with serious accidents, disability kind of situations. So through those claims, we were also able to avoid 150 delinquencies. So say between LAP and home loans, if the average ticket is about 40 lakh of rupees, that could have been an additional 60 crores of delinquencies which would have come in, which were avoided. So that's the principle number one, and then it also makes us a reasonable amount of money.
Got it. And final question is on, so the tax rate, was there anything, one-off during the quarter? What should we look at it sustained?
So sustainable is about 25%. Basis how capital gains and losses are taken on our on the liquidity that we employ into mutual funds. There could be a quarter variance between quarters, but generally speaking, for the full year going forward, you should expect between a 25 and 26% tax rate, which will be marginally higher to where it was earlier at between 23 and 24%.
Got it. Thank you. Thank you very much.
Thanks, Anil.
Thank you. We have the next question from the line of Subhranshu Mishra from Motilal Oswal Securities. Please go ahead.
Hi, thank you for the opportunity. 2 questions. One is for construction finance. I wanted to understand what percentage of construction finance is from the top 5 cities and what has been the average ticket size and the number of transactions you did in the year.
Okay. Top 5, extended to 6 will make almost 95% of the construction finance that we do. The average ticket size will be, I don't have that number handy, but it will be in the ballpark of between 200 to 300 crores. Okay. And which is the sanction. Disbursement could be lower. And sorry, what was the other question around this?
The number of transactions you did in fiscal 18 versus fiscal 17.
Yeah, so you can divide the CC, the commercial book disbursement by that number. I'll just give it to you. It's math. Give me 1 minute and I'll come back to you.
Sure. So the second question I had is how do you break up your disbursements in terms of new sales, resale, and balance transfer?
New sale will be roughly about 65%. Balance transfer will be another 10 to 15%, and about 20% would be resale transactions in home loans.
Right. And the number of transactions in construction finance, if I could have that.
Yeah, so we would have done about 60 loans this year as against around 50 loans last year.
And just a small outlook on construction finance for fiscal 19 and 20 both.
So it's already about half the book post-RERA, and for the last year or so we have gotten reasonably comfortable with this segment. I think it will remain at about half, close to half the disbursements and half the book of commercial loans. Overall, commercial loans will directionally be moving down slightly from the current 21%. But the split between lease rent discounting and construction loans, which used to be at one time 60-40, is now closer to 50-50.
Right. Well, thank you so much for your time and best of luck.
Thank you.
Thank you. The next question is from the line of Adarsh Parasampuria from Nomura Securities. Please go ahead.
Hi, Gagan. Firstly, question on sell down, right? So if you can just refresh in the last 6 months, what rates have you sold down at? Over the next 2 years, what's the kind of funding cost you would expect vis-a-vis, say, a bank loan or a bond? Or, yeah.
So priority sector loans will generally be sold at between 7 and 7.5%, and non-priority sector loans will be sold at between 7.5 to 8%, close to the bank's MCLR plus minus 10 basis points. Priority sector loans will have a discount. So going forward, we expect securitization to be in the ballpark of 7.5% or slightly lower. It really is a function of demand. This year, fiscal 19, there will be very strong demand from foreign banks because the guidelines have changed. And this number could move down by 20-25 basis points on a relative basis. It will be in the range of 7.25.
So for you, half your book or sell downs are generally PSL, is it?
In the fourth quarter, they are slightly higher and more priority sector. In general, it is 60-40, 60% priority sector and 40% non-priority sector. As home loans grow, it will become even higher on priority sector. So on the longer term, you can expect 2/3, 1/3 split between priority and non-priority.
And the other question was on your spreads. I think the 311 that you report is for the full year for FY18.
311 is at the end of the year.
Yeah. So, and I'm just looking at 9-month number was about 322. So I'm just, is the fourth quarter like, the 277 you mentioned was the fourth quarter spread?
So 311 is the spread as of 31st March 2018. For on-book loans. 322 was the spread for on-book loans as of 31st December 2018. For the loans that we would have done between 1st January 2018 and 31st March 2018, the spread would be 277 basis points. If we look at the same loans, which is the loans that we did between 31st January 2018 and 31st March 2018, the spread for home loans has now increased to, so the overall spread would be now in the ballpark of 3.1%. We've increased home loan rates by 20 bips, LAP rates by 40 bips and all that. So the overall effective increase would be between 20 and 30 bips for the overall book.
Okay, so the 277 moving to 300, 310 is a function of the increase of 20 and 40 basis points broadly. That's
right. And 311 would have also moved up by between 20 and 30 basis points.
Perfect. Sounds good, Gagan. Thanks a lot.
Thank you, Adarsh.
Thank you. The next question is from the line of Manish Oswal from Nirmal Bang. Please go ahead.
Yes, sir. Thank you for the opportunity. My question on the repayment rate in the housing loan book what is the repayment rate last 12 months?
I think, on a public forum, I must compliment my team because we worked really extremely hard to make sure that our prepayment rates continue to trend down, and we've had, in a year when banks were quite hungry for assets, we've actually had very low rates. So they are down to about 75 basis points of amortization on a monthly basis.
Okay.
And this is, generally speaking, an outcome of having priced in line with the leaders over the last 9 years. So there is no real arbitrage in the market, and there has been a very conscious effort over the last 18 months to make sure that prepayment rates in the company continue to trend down. And this year we have taken internally even more stiffer targets, so hopefully we should be able to sustain at least this much. In a rising interest rate environment, anyways, at least in the short term, the pressure is lower.
Secondly, sir, in terms of our overseas funding rate, cost of funds, overseas funding, what is that number? And secondly, of our total loan book, how much percentage is fixed rate loan book, sir?
There is, on the asset side, there are practically no fixed rate loans, negligible. And ECBs, we went through an exercise of refinancing all of our ECBs, and we were able to successfully materially reduce our rates, which were north of 8%. Now they are down to 7.5%.
And this Masala bonds, what rate we have raised, sir?
Masala bonds we raised at 7.8% annualized, which will be roughly about 7.45 monthly.
Okay, sir. Thank you very much and all the best.
Thank you. Thank you, Manish.
Thank you. Before we take the next question, a reminder to our participants that you may press star and 1 to join the question queue. The next question is from the line of Mark Smith from Sierra Capital. Please go ahead.
Thank you. Can you elaborate on the general provisioning policy? Because I seem to remember that there was a target of $100 million, 160% of coverage, which you would appear to have gone through. So exactly what is the policy there? And how do why are you making these general provisions? What will they just sit there on the balance sheet? Perhaps you could elaborate somewhat.
So the general concern that management has is that we have about a fifth of our loans which are reasonably large in size. As I mentioned, most of our large loans will be on an average at least 50 million in size and could be even larger. And as markets have been volatile in India, as events which are structural in nature get rolled out, there is a possibility that at some time suddenly a couple of guys are unable to manage, and then we have to make provisions in the very short term on such loans. As the loan book increases, we should have adequate buffers. So the two buffers that we carry on our asset and liability side is, on the liability side, we carry 20% of the loan book in the form of cash, and we have been adhering to that. And on the asset side, we would, in the ideal world, try and create a provision pool which is as much as 100 basis points of assets, till the time that this number of the large pool gets down to more somewhere around 15-16%. Till that time, we should have at least 100 basis points of provisions. These provisions can come in handy. If you recollect, we were hit by a large loan default, and we were able to manage all of that, thankfully, because we have some flexibilities on our financials. So in that context, we would like to build a buffer, and from a provisioning policy point of view, till we get to about 100 basis points, we would want to run credit costs at about 70 basis points, and after that, they will decline to about 50 basis points. I hope I answered your question, Mark.
the 70 basis points, that would be a reduction from, 98 that we've just had in this fiscal year just finished?
98 was because we had a large gain in Q3 from the stake sale that we did of Oak North Bank. So that was more opportunistic. In normal course of business, it would have been closer to 80 bips, which should decline this year to roughly 70 bips.
Okay, so we should expect a gradual decline over the years
to 50
towards the 50 running. But 50 basis points not until 2023, you're saying now. You used to say 2020.
2020 we should get there.
Okay, 2020. Thank you very much.
Thank you, ma'am.
Thank you. The next question is from the line of Saurabh Kumar from JP Morgan. Please go ahead.
So just on this construction finance book and the LRD book, have you seen any spread compression happen in these books in the last 1 year?
There was pressure on the rent discounting book, not so much on the construction finance book in the second half of of fiscal 17 and around the first quarter of fiscal 18. Second quarter onwards, things stabilized. I think fourth quarter rates have effectively moved up. As an anecdote, we were through the middle of the quarter thinking of that at least $500 to $600 million of our loans by the end of the quarter will get refinanced. And therefore we front-loaded our loan growth in the quarter in anticipation of this, and practically nothing got refinanced because banks just simply vanished. When we're looking around in the market, rates have actually moved up. So I think that entire rate reduction, not only rates have moved up basis the MCLR increases which have happened, but spreads have actually increased. So in that context, I think the competitive pressure is off. Most banks today have already gone way past their commercial real estate limits. That's a large part of the lending that they were doing. My personal expectation is that fiscal 19, we should actually see an increase in spreads on this book.
On both construction and LRD, you think?
Yes, especially construction, because construction is one segment that banks are completely absent from.
Okay. And sir, what will be the duration of this LRD book now?
LRDs will typically be contracted for 9 to 10 years, but they have a strong tendency of getting refinanced between the third and the fourth year.
Okay, and just one final question on this cash and investment. So should we assume that the proportion related to balance sheet continues to remain where it is, or
it would. Thanks to these credit rating upgrades, the ability of the company to place out 7 to 10 year paper has materially increased. The proportion of bonds placed out with provident funds and insurance companies is also materially increased. So in that context, it will remain between 15 to 20% of our loan book and not 20 to 22% that we were historically running it at.
Okay, but there's no negative carry on this now, you're saying?
So far we've avoided, and as things seem I think we will be able to manage to run it quite tightly.
Okay, thank you.
Thank you. The next question is from the line of Ashwin Balasubramaniam from HSBC Asset Management. Please go ahead.
Yeah, hey, if I look at the consolidated balance sheet, which is an exchange filing, apart from the 16,000 crore of cash and liquid investments, there is also another 3,000 odd crore of non-current investments, which has increased by about 2,000 odd crores. So what would that pertain to?
That would be government securities and tax-free bonds.
Okay, so that would be similar to the liquid part of it.
Yeah.
And what would be your yields on various portfolios currently on a book basis?
Yeah, sure. Yeah, so home loans would be on stock basis about 9.4%. LAP will be about 12.5%. CV will be, CV is insignificant. LRD would be 10.2%, and construction finance will be a little over 15%.
So you said that you had also increased your rates in the LAP segment by about 40 basis points. So, given that it's already at 12.5 and that segment continues to see competition, so would you be able to pass on the entire 5%
prepayment penalties, which stop people from... so if you have to recover that 3 to 5% prepayment, and it's generally a product which comes back between 3 and 4 years, you will have to get LAP loans at in single digits to be able to make good that penalty, which is rarely the case. So, which is why the product has very little refinancing risk, and incrementally rates for us will also be in the ballpark of 11%. So that book continues to, on an incremental basis, get us around 11%.
Also, the teams are very well trained to retain customers. So whenever there is, for 25-50 basis point, people don't really come. But in case there is a sustained interest rate increase, there is pressure on prepayment, which the team is able to contain, and we are able to offer some switch policies in case somebody is already being offered much lower rate.
Oh, thank you.
Thank you. The next question is from the line of Subramanian Iyer from Morgan Stanley. Please go ahead.
Hi, Gagan. Congrats on a good set of numbers. Just needed a couple of data points. Can we have the number for zero coupon bond cost and NCD issuance cost for the fourth quarter last year, this year, and also for the full year, FY17 and 18?
So the stock will be around 2,000 crores, and the number that we would have taken for zero coupon is in the ballpark of 225 crores. This, with the implementation of Ind AS, anyways goes away, so everything goes through the P&L now.
Okay. And what would be this number last year?
The number last year was 100 and... So we have between premium and fees, last year we had paid 261 crores. This year we have paid 285 crores.
Got it. And on the tax rate, if you can give some explanation, how long can we see the tax rate sustaining around 25-26%?
It is, a function of the cash, since we will always maintain at least 15% of the cash that will sustain for 6 months of all liability payment with a margin of 25% and our retail disbursement continuing. I believe that opportunity remains. Basically, this tax rate is nothing but which is reducing the negative carry. So there is a negative carry on one side, and there is a lower tax rate which is neutralizing that negative carry. So it's a function of cash, and we look forward to maintaining at least 15-17. Earlier it used to be 20-22% of our balance sheet, and the effect on the tax rate was more. Going forward, it will reduce to 15-18%, and the tax rate should be around 25%.
Got it. And lastly, any guidance on the impact of Ind AS on the numbers?
No, we are frankly working through that. The general expectation was that it will get deferred. It still is the case that I am being told, but we are anyways preparing for it. The last time we had looked at it, there was nothing very material. There is a lot of clarification that we still need from the regulator, and post which we should be able to more accurately predict. We have been taking stock quarter by quarter. There was nothing which was going to be extremely material. There would be some element of transition, and that transitionary box will have some number there. I am not yet on top of what that number is, but I am reasonably confident that it will not have any meaningful impact on net worth.
Sure. Thanks a lot.
Thank you. The next question is from the line of Sashank Salwa from Lion Trust. Please go ahead.
Hi, Gagan. I remember last year when we met, you had mentioned that the target for Tier 1 is to keep it above 15%, and we are quite very close to that level right now. And also in terms of gearing, as I see on page 55, it has risen to 7 times from 5.7 times last year. So how do you see these, and in terms of like equity raising going forward? Because you had mentioned you raise equity every sort of 5 years or so. Are you comfortable with the levels of capital you have right now, or do you think you'll need to raise these anytime soon?
Yeah, so prior to our upgrade by the rating agencies last year, we were capping our gearing to 7 times. That now, given the higher scale of operation and vintage of the book, we are comfortable to push it to a maximum, at least in the near term, of 8 times. So between 7 and 8 times, we will raise capital, which gives us a flexibility of about a year and a half or so. Risk-weighted assets, as I mentioned, have been declining. In 1 year itself, we've been able to cause a decline of 83% to 78% of total loan assets. So Tier 1, between a reduction on book of risk-weighted assets and securitization, we will still be able to manage. I think the number we will be guided by will be gearing. And gearing at between 7 and 8 times, we will raise capital. So over the next, anytime over the next 18 months, we will raise. What management did not want to do, despite market, etc., was have an ad hoc approach to it. And therefore, we have stuck to our commitment that, not before 7, and we are at 7 now. Between 7 and 8, we will raise capital.
And any sort of changes to the dividend policy, like instead of raising capital to reduce the payout ratio or something like that?
So we will follow a 50% of profits, including the taxes, as our long-term dividend payout policy, and that's what we started following from this quarter. Last quarter, we were able to give a ad hoc additional dividend because of the capital gain that we got on the bank stake sale. This year onwards, we will follow up this quarter onwards, we will follow a policy of 50% of profits, inclusive of taxes.
Right. And how much of your liabilities are on fixed rate basis?
So the bond program is generally on fixed rate basis. Bonds which are longer than 3 years, we generally swap them out. That's the general principle that we have. In a consensus flat to rising rate kind of an environment, we can be slightly conservative on the swapping plan. As we speak, close to about 30% of our 30-35% of our bonds we would have swapped out.
And when, like even the floating ones, like when is it actually reset? Is it reset sort of on a monthly, quarterly, annual basis?
Our borrowings?
Yeah, borrowings and as well as the assets.
Our asset can get repriced anytime that we reset on a monthly basis. So if I choose to reset it today, it will be applicable from 5th of May. So that's the cycle that we follow. On a liability side, bank term loans can get reset anywhere between 1 and 6 months.
Right. Okay. Thanks a lot.
Thank you. The next question is from the line of Rakesh Jain from Jasper Capital.
What would be the additional business that we have done in the affordable housing segment during the year?
Rakesh, as I've tried to explain in the past, the affordable housing definition of the government of India now is income levels going up to 1.8 million rupees. The average borrower of IndiaBulls home loans has an income level of approximately ₹1 million. So bulk of what we do qualifies for what is defined by the government as affordable housing. For priority sector, for the metro cities, Central Bank has a definition of up to ₹2.8 million. Our average ticket size is 2.4 million. So bulk of what we do there is also affordable housing in that sense. So largely, most of the home loans that we give out are what is under the new definition of affordable by Government of India, all in there.
And what would be the subsidy under the PMAY scheme you have received for the entire year?
I can come back to you on that number. It had materially jumped towards 7 March. So that piece which was earlier struggling has extremely materially improved. It will be a few thousand loans. I can come back to you on that.
Okay. So are there any challenges in receiving the money from the government or any delays kind of thing?
There are not money challenges. So the government is extremely keen to disburse. There are operational challenges. One has to be extra careful about how the claim is being done, and we have to keep a very tight vigil that we are making the right kind of claims. We don't want to be subject to an audit in which then something is found lacking at our end. And once we submit papers, the same are also scrutinized by NHB, because they also don't want to get a rap from CAG. So everybody is being super careful. Apart from everyone being super careful and going over all documents 5 times, from a money point of view, there is no challenge. Actually, the government funded NHB extra towards the end of March to make sure that, so there was a meeting held, I think, sometime in early March, and then there was extra funds made available to NHB to make sure everyone's claims are taken care of.
Okay, thanks a lot.
Thank you very much.
If there is no question, let's finish this, or we can take a maximum of one more question, then we have to rush out.
Okay, sure. We have one last question in queue. Last question is from the line of Alpesh Mehta from Motilal Oswal Securities. Please go ahead.
Hello.
Yeah, hi Alpesh. Please go on.
Hi. Thanks for the opportunity and good set of numbers. Just one question, disbursement breakup for the full year. You have already given for the fourth quarter, but just for the full year.
Sure. So we did a disbursement of around 48,000 crores, of which home loans was roughly 26,000, LAP was around 8,000, and commercial loans were around 14,000.
Okay, and just a request, if you can just put this as a standard disclosure in the presentation, that would be very useful.
Okay, I will try to.
Sure. And just the last one clarification.
Notice has already gone to 72 pages.
And just last clarification about the Ind-AS, the communication, you will get the communication from NHB or from the MCA?
We will get it from MCA, and NHB will implement what MCA says. The guidelines in terms of, so today NHB has basically said that the provisions, etc., we have to follow as per the regulatory norms laid out by RBI. If that be the case, then there is a direct contradiction to what Ind-AS expects us to do. So there is a little bit of confusion there. If we are to just apply Ind-AS as is understood by the top consultants in the country, as I said, there is no meaningful impact on net worth or earnings that one can visualize here. If these guidelines are to be implemented, then there is no impact at all. I think over the coming days, we will consult with our regulator and figure out what's the way forward.
Yes, thank you. Thanks a lot and all the best.
Thank you. Thank you, everyone. Fiscal 18 was a great year, and on a very optimistic note, we will sign off. Thank you for your support, and look forward to speaking with all of you in July. Thanks.
Thank you very much.